A new tax proposal in Washington could change how Americans buy cars. The One Big Beautiful Bill Act includes a deduction for interest paid on new car loans, championed by Donald Trump and passed by the House in May 2025. If it becomes law, buyers could subtract auto loan interest from taxable income, offering relief from high rates and prices. The deduction is temporary, only for loans from 2025 to 2028, potentially spurring a rush to dealerships. It's an above-the-line deduction, so you don't need to itemize to claim it, making it accessible to most Americans. However, the bill also ends federal EV tax credits early, adds new fees for EV and hybrid owners, and tariffs are already raising car prices. So while some buyers might save on interest, they could pay more elsewhere. The real impact depends on your situation and the final version of the bill. The deduction lets you subtract up to $10,000 per year in interest on a new auto loan from your taxable income. It's not a tax credit, but a deduction, so your actual savings depend on your tax bracket. For example, in the 24% bracket, deducting $4,000 in interest saves you about $960 in taxes. You don't need to itemize, so millions of middle-class families could benefit. The biggest savings come in the first year of the loan, when most of your payment goes toward interest. Over time, as you pay down the principal, the deductible interest shrinks. For the average new car loan, about $43,000 at 9.5%, the first-year tax savings are around $900. Helpful, but often less than a single monthly payment. The deduction is real, but it won't dramatically change affordability for most buyers. To claim the full $10,000 deduction, you'd need to pay $10,000 in interest in 1 year, requiring a loan of about $112,000. That's the territory of luxury vehicles like a Porsche 911 or a high-end Range Rover with monthly payments over $2,000. Only about 1% of new car loans are large enough to generate this much interest. So while the maximum benefit grabs headlines, it's out of reach for nearly everyone. Most buyers will see a much smaller deduction tied to their more modest loan size. The biggest tax breaks go to the most expensive purchases, raising questions about who really benefits. For most families, the deduction is helpful, but not a game changer. There are strict income limits. The deduction phases out for singles earning $100,000, $150,000, and couples at $200,000, $250,000. Ironically, those who can afford six-figure cars often earn too much to qualify for the deduction. Lenders also rarely approve huge loans for middle-income buyers, so the overlap is tiny. The car must be assembled in the U.S., excluding many popular foreign models. There's also confusion about whether used cars qualify. The bill isn't clear. For now, the focus is on new U.S.-built vehicles. But eligibility could change. These rules narrow who can actually benefit from the tax break. For most buyers, the new deduction offers modest relief, maybe a few $100s a year, but tariffs and the loss of EV credits could raise prices by thousands, wiping out those savings. EV buyers lose up to $7,500 in credits and face new annual fees, making the deduction a poor trade-off. The bill shifts costs around, helping some while hurting others, especially those interested in electric vehicles. The full $10,000 benefit is mostly theoretical, requiring a rare mix of a huge loan and middle-class income. For most Americans, the deduction is helpful but not transformative. The policy could cost over $57 billion in lost revenue. Lawmakers must decide if this is the best way to help families struggling with car affordability. If you found this video helpful, please subscribe, like, share, and comment to keep these videos coming.